do some trading. Let's get ready for the big earnings tonight. That is Tesla. We're in the midst of a market rally. Bulls should be able to flex a little bit if today's going to be a macro day because economic data did come in light. In case you missed it, their PMIs slipped relative to expectations. Stock market is rallying as a result. Bonds rallying too. Tom White joins me here in studio. Nishit Madlani joins us from S&P Global Ratings Managing Director with Tesla in the purview. Okay, Nishit, tell me the baseline here. What's the most important metric for Tesla this afternoon?
Yeah, first of all, good morning, Oliver, and thanks for having me. So yes, I mean, we have a BBB credit rating on Tesla here at S&P with a stable outlook. Obviously, a big day with earnings later today. Look, if we take a step back, the level of growth they've achieved over the past 5 to 6 years, that was not going to be easy to sustain, right? So it's only natural to expect more volatility in results. When I think about, what from a rating agency standpoint is our main view is where are profit margins and cash flow headed from here? Remember that despite all their challenges, we're still expecting about 14% margins, and that's not very common in the auto industry. Yes, it's probably going to be, the first time that their deliveries dropped since mid-2020. But from our perspective, the main things we're most focused on is, can they lower manufacturing costs on their next generation platform launch? Can they secure, battery component supply, especially lithium, while complying with all the IRA rules to be eligible for subsidies? Can they deliver on the robo-taxi promise and higher software costs? And while dealing with all of that, they still have to make the total cost of EV ownership more affordable. So those are things we're going to learn more on the earnings calls today. But despite these challenges, ton of cash in hand, a lot of financial flexibility. So that's why we have a stable outlook.
Okay. Now back to the core metrics. Margin, cash flow to me have been so impressive for Tesla over this past year as autos have been cutting prices generally. Even with the slowdown, we've seen their margins look much better than their legacy peers. Catches it hasn't been a positive for the stock or the credit, I imagine, either. But it seems like that's what is their real strong case. How much of it depends on fresh new demand? How much of that margin has now just been a virtue of the way they build their cars and the efficiency with which they run the company?
I mean, a lot of that has been all of that, right? So you think about the efficiencies they've built with their second, third generation platforms, the margins they achieved, were not items that people were forecasting about 5, 6 years ago. So yes, I mean, right now they're going through this challenging period where clearly we're seeing a slower growth relative to expectations for the EV demand situation all around the world, not just here. And one of the trends that's emerging is that the second wave of buyers is more price sensitive, more picky, more value oriented. And if you really break down the reasons, the prices are too high, and that's why they've been cutting them. Charging infrastructure in the country overall still not widespread. And of course, if you look at subsidies, they're getting phased out, getting harder to get. So for that reason, I think it's very important for first of all, for us to see price parity being achieved. And then once that's achieved, continuation of all that they've done in terms of efficiency, lowering costs, while not compromising on all the good stuff, all the technology and the OTA software.
Okay, so the price parity, I mean, that sounds like a message about, more price cuts, or do you factor in the cost efficiency of having an EV once you buy it versus gas? How does that factor in? Because I would imagine that changes your model for expecting when their price cuts will be over, because it sounds like you're arguing there will be more price cuts.
Yeah, I think for the broader industry, we do expect over the next 12 to 18 months price cuts, and therefore, getting towards that price parity in at least the majority of the segments in the US. Look, eventually for reducing battery costs, you need scale. And to get scale, not just for the broader domestic automakers, but even the foreign automakers that are planning to launch these vehicles, price has to come down. And that has to come down without compromising on technology or the cockpit experience. So how do we get there, right? So to get there, we need to make sure that the sourcing strategies that these automakers have can get adjusted so that they're still eligible for these tax credits, because that's going to help. So the requirements are quite tough, like for 24, 60% of the battery components have to be assembled in North America. At least half of the critical minerals have to be sourced from North America or free trade partners. So even though price parity may be achieved fairly soon, profits within the broader EV segment, we think is going to be unlikely, at least for the next 2 to 3 years. So we're going to see a lot of transition through hybrids and plugins. So those have been making a bit of a comeback.
Do any of the, real quick, Nishit, because we're going to do some trading, do any of the models right now include robo-taxis, include the stuff that Elon's been teasing we're going to see later this year?
Look, from our perspective, that is clearly an upside to the ratings base case. It's not something we factor in.
Okay.
So it'll be very interesting to understand,
if they can pull it off positive.
Yeah, what's the messaging around that, the timing relative to launching, let's say, an affordable vehicle, which from our standpoint is more important at this stage.
Understood. Great stuff. Thank you very much. Good perspective from the credit side. Nishit Madlani from S&P Global Ratings. Tom White, how are the options looking?
Implied volatility levels are elevated. Option market's pricing about a plus or minus 9% move in the shares.
Okay.
So not
Is that
outsized.
A lot or little average for Tesla?
It's about average, actually a little bit light, but maybe the move's already built in.
Because it's gotten a thrashing, basically?
Yeah, short open interest is at 3-year highs at this point right now. So that in itself could lend to some upside in case this is an earnings meet. Maybe they guide a little bit higher. Maybe they say some more cost-cutting initiatives moving forward, robo-taxi. There's a lot to deal with here going into this, so stay risk-defined.
So obviously earnings always have an implied vol that gets pushed up around that event, but because Tesla's been so swingy and generally been selling off more, does that kind of normalize it to where like the trailing vol is similar to the expected?
It actually helps a little bit as far as the 1 standard deviation moves that the option market's priced in, because expectations are so low going into this. And you got the market rebounding the last couple of days. That's also helped a little bit as far as implied volatility level, but they're still elevated. You've got about 130% implied volatility on aggregate in the near-term options.
Am I wrong, or is it interesting that the implied vol hasn't been firm while the stock's selling off?
No,
Okay.
Because it's been a pretty consistent downturn. We haven't seen those big, massive moves to the downside on a daily basis. So the intraday moves have been down, but they've been...
Last week was pretty rough.
Yeah, they were pretty rough, but we've passed that week already. So remember that these things are really implied volatility levels dynamic, but still, nearly a 10% move either way in the shares. It's pretty big when you're talking about $140 stock. So the first strategy I looked at is a little bit more neutral to bullish. If you think, hey, I'd like to pick up the shares if they do sell off post earnings, but if they don't, I can still profit on it if the stock moves higher or really, consolidates at these current levels. So I looked at a cash secured put, neutral to bullish. So I went out to the May monthly cycle. So giving myself 3.5 weeks till expiration, selling the 138 strike put. That's out of the money to the downside by about $5 or $6. You're collecting roughly, I've got 770 credit on it. That's where it was when I looked at it earlier. Stock's back above 144, so you're collecting probably closer to $7.
Betting that this builds a floor at its low price yesterday.
Yes. Yeah. The 138 strike is. Yeah. The break even on this one, if you sell this naked short put, is going to be about just above $130 to the downside. That's about 9% below the current share price. It's about that 1 standard deviation. But this is twofold. You either want to just keep that hefty credit that you're collecting due to higher implied volatility.
You hope the implied vol comes down post earnings.
But you might be comfortable if you hold that short put and it goes below 138 at expiration, you'll own the shares
Tesla
at just over $130.
All right, that's a fine trade. What else you got for me? This is Tesla. Give me a 0-day expiry, Tom.
Well, I'll give you one that takes advantage of that implied volatility in the near-term
options. Give me some short-term stuff here.
A little bit more bullish,
of puts.
a little bit more aggressive. I looked at buying a call diagonal. So I'm going to go out to the May monthly cycle, 24 days to expiration. Buy slightly in the money call, the 142 strike. It's got that higher delta, reacts more like the stock. And then in the near term, April 26th weekly options that expire in just 3 days, sell the 155 strike call. That's about that 1 standard deviation.
There we go. Now we're having fun.
That you're expecting. So if you think it's going to move up post earnings, this is a strategy that works.
Lower probability, lower probability, but higher outcome and reward if you hit it.
Yes, definitely. And you get those the ability to roll that short option as you get closer to expiration, as implied volatility comes out of those post earnings vol crush that we'll see in those. You're paying roughly about an 830 debit. It's probably closer to 8.5, 870 on that. But that debit,
because it's gone up a little bit.
yeah, because you're
2%
buying
now.
you're buying the 142, selling the 155. That's a $13 wide call diagonal, and you're paying just over $8 for it. So anything above that break even, about $140, is going to be profitability. And the dispersion between implied volatility levels, where you're buying about a 75% implied vol in the May cycle, selling about 135% in the near term, April 26. So that's what contracts the price of it, makes your risk lower on this bullish trade.
All right, but if it goes to 156, 155 tomorrow, then it kind of starts, you max out.
You max out on that, but you've got that short option to continue to roll. That'll increase potential profitability.
All right, thanks, Tom. All right, two ways to approach it, both generally bullish.